So let us see the next question. The next question is trade-off theory of the capital structure. This is only the theory that we have. No practicals, no numericals are there. Let us see that say what kind of the theory that this is about. The trade-off theory of the capital structure refers to the idea that a company chooses how much debt financing and how much equity finance to use by balancing cost and benefit. The word trade-off stands for that say there is certain advantage and certain disadvantage. Uh, Trade-off theory of the capital structure basically entails offsetting the cost of the debt against the benefit of the debt. Dear students, cost of the debt means increase in the cost of equity is cost of debt. That is the way we have to understand the cost of debt. Benefit of the debt is like raising the funds having a lower cost is the benefit. Benefit of the debt means we have the trading on equity advantage is the benefit of debt. Trade-off theory of the capital structure primarily deals with two concepts: cost of financial distress and agency cost. Dear students, over here, so the technical words are financial distress and agency cost. So basically we understand that say the cost of debt is consisting of these two things: financial distress and agency cost. An important purpose of the trade-off theory of the capital structure is to explain the fact that the corporation usually are financed partly with debt and partly with equity. It states that there is an advantage of the financing with the debt, that is the debt, the tax benefit of the debt, and the cost of financing the debt, the cost of the financial distress, including bankruptcy cost of the debt and non-bankruptcy cost. Example: staff leaving, supply demanding, disadvantageous payment terms, bondholder, stockholders infighting, etc. So it says something like this: the term bankruptcy cost stands for the chances that the company will say go into the liquidation. That is what we understand is the bankruptcy cost. And so that is what we understand is a financial distress. The marginal benefit of further increase of the debt declines as the debt increases. So when you raise the debt financing, then in that case, so gradually the advantage of raising the debt financing reduces, while the marginal cost increases. Means the cost of equity will increase at a higher rate. That is what it says. So the firm is optimizing its overall value, will focus on the trade-off when choosing how much debt and equity to use for the financing. Modi, Gilani and Miller in 1963 introduced the tax benefit of the debt. Later work led to an optimum capital structure which is given by the trade-off theory. According to Modi, Gilani and Miller, the attractiveness of the debt decreases with the personal tax rate on the interest income. A firm experiences financial distress when the firm is unable to cope up with the debt holder's obligation. If a firm continues to fail in making payments to the debt holders, the firm can be insolvent. Now friends, over here they have provided a word like debt holders obligation. What does that mean? That means the payment of the interest. What does that mean? That means the repayment of the principal. And if at all you do not meet them, then in that case the company will be closed down. It does not happen in case of the equity financing. The first element of the trade-off theory of the capital structure considered as the cost of debt is usually the financial distress of the cost or the bankruptcy cost of the debt. The direct cost of the financial distress refers to the cost of insolvency of a company, means the chances that the company will go into the liquidation. Once the proceeding of the insolvency starts, the assets of the firm may be needed to be sold at distress price. Means we know that's always in auction, the price which you are able to get will be less. The reason behind that is that the buyer is aware, now the seller is having say like in a situation wherein they have to sell the that is assets. So the bargaining power of the buyer is more than the seller, which is generally much lower than the current value of the assets. A huge amount of the administration and the legal cost is also associated with the insolvency. Even if the company is not insolvent, the financial distress of the company may include number of indirect costs, cost of employee, cost of customer, cost of supplier, cost of investor, cost of manager, and cost of shareholder. The firm may often experience a dispute of interest among the management of the firm, debt holders, and the shareholders. These disputes are generally give birth to agency problem that in turn give rise to the agency cost. The agency cost may affect the capital structure of the firm. There may be two types of conflict: shareholders, the managers conflict, and the shareholders, debt holders conflict. The introduction of the dynamic trade-off theory of the capital structure makes the prediction of this theory a lot more accurate and reflect that in the practice. So over here, say the diagram works like this. Let's say initially when you raise the debt financing, then value of the firm is moving up. Beyond the point it is going down. So the point at which it is going down, then in that case the company should stop raising the debt financing. That is, the company should stop raising the debt financing at the maximum value of the debt. That is what we understand. As the debt equity ratio, that is leverage, increases, there is a trade-off between the interest tax shield and bankruptcy, causing optimum capital structure.